And strong economic data and expectations that the upcoming administration's policies could keep inflation sticky are keeping yields sticky, moving to the upside still this morning. That is putting some pressure on stocks. What's driving the moves and what does it mean for your portfolio? Here to discuss, we've got Ken Mahoney. He is the CEO of Mahoney Asset Management. Ken, great to have you in studio with us to discuss this. And actually, sorry, Ken, you are joining us virtually. I just wanted to start with you on what we're seeing in terms of the impact on stocks this morning and how much potential risk that could continue to have for investors moving forward here if we do continue to see yields moving to the upside.
Right. So it feels like, Monday was a melt up. Yesterday was a meltdown. Today we're still undecided yet. And it's like Dr. Jekyll and Mr. Hyde. And a lot of investors wanted to hide yesterday after that, 380 point turn of events for the NASDAQ. And, this Trump 2.0, look, we're going to make volatility great again. There's no doubt about it. There's 2 a.m. tweets about tariffs with China. It doesn't sit well with investors. While there's a lot of tailwinds with this new administration or old administration coming back, the 2.0 as they call it, because the tailwinds clearly it's going to be more pro-business, friendlier growth environment, regulation calming down a bit to let companies breathe a little bit. But the tariffs, it's like these algorithms that keep following that. You say the word tariff, and yesterday you said the word tariff, I think 16 times in like 20 minutes. Investors don't like that. They still don't know how to evaluate that. Now, we hope that the tariffs or the talk about tariffs is more about negotiation than it is actually striking and doing that. So a lot of stuff going on, a lot of cross currents, as you mentioned. And the big bugaboo right now, so far early in 2025, the 10-year at 470. It looks like it's going to go to 5% pretty easy. So again, we got to stay in the lane with more growth or some interesting story stocks because that's more competition, right? That's a lot more competition in stocks when the Treasury or if the Treasury yields 5%.
All right, Ken, a lot to get into here. But first, just following up quickly on that Treasury yield point. So here we are right at 4.7. If we do see it breach 5%, what does then the equity market reaction look like?
Well, first of all, the steepening of the yield curve is going to show that, a couple of things. First off, inflation may raise its ugly head the back half of this year. That's what the bond market's maybe telling us. It's also telling us that a lot of entities, especially these foreign countries, are worried about the $36 trillion, what's the number today, $35 trillion deficit and want more of a rate for the risk. Again, we're not going to default, but certainly there'd probably be some downgrades. S&P may go from AAA to AA plus or whatever the case is. So, something that investors are watching very, very closely. I'm watching the volatility index rise yesterday, concerned about inflation being sticky and a pro-growth agenda. Why it's great for earnings, it's not great for inflation. And those are the cross currents that we're dealing with currently.
A lot of cross currents to look at, especially as we anticipate the policy changes to come under the incoming administration. You offer 2 sectors to avoid under Trump 2.0. You say food and pharmaceuticals are areas to avoid. Why is that?
Well, the target's definitely on the back of pharmaceuticals, especially if Kennedy gets nominated, which it looks like he will. Food companies for a long time, look in the UK, there's 1,300 products out there that are banned, and yet we have them in place, especially the dyes and so forth. There's so many interesting things that are happening with AI spend and the build outs and so much excitement and top line growth. Pharmaceutical is going to be, looked at very, very differently than the last administration. So I don't want to be a hero. I know they look cheap, but I believe you'll be stuck in quicksand for some time, and where yet the opportunity cost is so immense, to miss that cycle, this great cycle of spend, to be try to wallowing in pharmaceuticals. So those 2 areas completely we would avoid, pharmaceutical and food.
Well, you've also got 3 stocks for us, and you're saying that they are safe picks no matter what happens. And in those 3 names, you have JP Morgan, NVIDIA, and Walmart. What stands out about these 3 names and why you still see them attractive here for investors, regardless of the macro environment?
Right. So Walmart, their online sales year over year is 25%. They're trying to take a bite of Amazon, and all this great data that they're getting, real-time data, helping them with logistics. That's a big thing with a big company like this, and inventory and pricing variability. So there's a lot of good things that, in fact, for Walmart, they seem to have a pretty good relationship with their customers. And again, it's a beta of 0.55. So when you match like NVIDIA, which is going to be a beta of like 1.5, like 50% more volatility than the S&P 500. It's nice to have in your portfolio a couple of slower movers, a couple of slower beta. Flipping over to NVIDIA, I thought last Friday kind of the big explanation point was that Microsoft is going to spend $80 billion this year in data centers. Now, again, I don't think NVIDIA is going to grab all the $80 billion. I thought the Consumer Electronics Show did very well. Look, leading up to Monday evening's keynote speech, last Thursday, Friday, and Monday, the stock was up 14 points. So we knew we were going to sell the news, on this, but it was kind of, but still, where else are you going to find this type of growth? And I know people complain, but look, the forward PE right now is roughly 40. The last 10 years historically, that's where NVIDIA trades. And then the other one we mentioned was JP Morgan. Again, less regulation in that industry should really help them grow. You say bank and growth, it sounds like an oxymoron. But Jamie Dimon knows what he's doing over there. Yes, rates are coming down, so interest income may not be as strong, but now they could actually look and place more loans with the less regulation. So, those three kind of combined give you like a little bit less than one market volatility, but the best in class in each sector.
All right, Ken, thanks so much.
Thank you.